Hey, welcome to the most exciting day of the week. No, it's not Taco Tuesdays. It's Mortgage Minute Thursdays. My name is Jeff Harrison. I'm excited to be here today with you, and we're going to have our expert, a mortgage man. I think it's like I'll have him verify this, but I think he's been doing this for 45 years. I mean, my goodness, if we think about all the stuff that's going on in the world today, he has seen it all, and I can't wait to dive into that today. Got a lot going on today. I'm gonna get Art in here in just a second, but I just want to point out that if you are first arriving here and you have questions and you're watching live, please make sure to put your questions in the comments, because once Art gets going, I'll jump back in the background and I'll put the questions on air, and Art will answer those. Now, for some reason, and I can't imagine you didn't schedule this today, that you see this recorded, but you have a question, please put it in the comments. And once again, Art will dive in and take care of that. So with that, let's bring Art in. Hey, Art, welcome to the show.
Hi, Joe. I'm Joe. Hi, Jeff. How are you?
That's okay. I mean, it's an exciting day. I could be Joe. If you need me to be Joe, I'll be Joe today.
And you're a little off in your math. I'm not quite 45 years in the business, only 42.
Oh, 42. I don't know where I come up with 45. For some reason, I was thinking I heard you in a meeting we were both in this week. I thought you said 45. Maybe it was somebody else. But
I'll be there before you know it.
Yeah, time just flies when we're having fun. So you got a lot to talk about today?
I really do. Yeah, it's been a really interesting week in terms of the bond and interest rate market. So, of course, we'll touch on that first. But then we've got some other interesting information, including the Q&A session that I think people are going to find very interesting. So, yeah, a lot to cover.
Fantastic. Well, with that, I'll jump out of here. I'll turn this over to you, and I'll be in the background. Thanks, Art.
Okay. All right. Thanks, Jeff. Hello, everyone. My name's Art Alvarez. I'm with Mortgage Works, where we do have the answers, and they're on the house. Welcome to this week's Mortgage Minute. As you know, I like to jump right into giving you an interest rate update. This was quite the week, particularly early in the week. There's our rate chart. That's our current rate grid on our website. So you can see current indications as to mortgage rates, which does reflect, the changes in the bond market yields that have occurred this week, particularly in the early part of the week. And Jeff's going to pull up this 5-day chart of the 10-year Treasury bond. Like I said, it was a wild ride. Late last week, ending of last week, the 10-year Treasury bond yield, my favorite benchmark for tracking mortgage rates, was right around 460. But going into the early part of this week, it shot up quite a bit. In fact, at one point yesterday, or certainly overnight, Tuesday night going into yesterday, the 10-year bond yield was, up in the 485 plus range, heading to 490. Quite a jump from the end of last week, almost 0.25%, in fact. But thankfully, as is often the case, today we've got some things settling down. The yields come back down nicely. As you can see, they're about 471. So what was going on this week that caused the change, particularly early in the week, and this big run up in the bond yields that really got the markets jittery, in particular the stock market that you saw sell off? Well, on Monday, we had the ISM Manufacturing Index. That's Institute of Service Manufacturing Index, and the index number was 49. That was up from the previous month, not quite expected. So that really sort of jolted the markets a little bit. Now, it's interesting, though, because under 50 is still considered a contractionary kind of a situation. But I guess the point is we're getting close to the end of the contractionary period by getting close to 50. So I guess that's how the market reacted. On Wednesday, yesterday, the JOLTS, that's the Job Opening and Labor Turnover Survey, that really shook up the markets. It was a super hot number, as they call it. What this is the number of job openings for September. It jumped up to 9.6 million. It was 8.8 million in August. So that was a big jump, not expected. And that's why we had such a big increase in bond yields yesterday. Yesterday we also had, the JOLTS was on Tuesday. Yesterday was the ADP employment number, ISM services order, and factory orders. These were mixed signals, and I pointed there, ignore ADP. I don't like the ADP number. It's always, oftentimes not very accurate. So not much happened with those releases yesterday. Today, we had initial jobless claims. They were up slightly, 207,000, about what was expected. So again, kind of a calming effect on the market. Tomorrow will be the government's employment report as well as unemployment rate. The forecast for employment is 170,000 new jobs, with unemployment to be at 3.7. So we'll see what happens there. And given this jittery market we had this week, I wanted to put on this slide a couple of quotes, if you will, things to kind of keep in mind when the market is so volatile. First thing is, and something I saw years ago from an economist who is unnamed, but I want to give him credit for it anyway. He made a comment on financial markets. They respond with reptilian-like minds to stimuli. Always keep that in mind, because when some of these data points come out, the markets can tend to react pretty strongly, and then ultimately they settle down a little bit. And the other thing, I think, in this environment, we have to be prepared for the fact that on rates, better think in terms of higher for longer. I don't think the environment is such that we're going to see, when rates do come down, that they're going to come down very quickly and dramatically. I think it's going to be more of an extended long-term process. So that's where we are with the mortgage rate and bond market. The next thing I wanted to jump into real quick, and I will cover this quickly, but I saw another Dave Ramsey article on the news feeds this week, and I wanted to bring it up. And in this case, as you know, in the past, I've brought up a Dave Ramsey article a time or two, and I've been a little bit critical or maybe disagreeing with some of his points. Well, in this one, I'm actually in agreement with him. And the headline, of course, was why Dave Ramsey says now is the time to buy a house, which, of course, sounds crazy, right? Home prices are still high. Mortgage rates are certainly considered very high, although really not historically. So why in the heck would he be saying that? Well, his point was, if your finances are ready, then the home buying market is ready for you too. And of course, he lists some issues that you should think about. One is other debt is a factor. Well, that's obvious, right? Certainly it is. But what he's getting at is, if you got a lot of credit card debt, big car payments, personal loans, et cetera, that's a factor. The other thing to understand is, he suggests, of course, he always has done this, adequate emergency fund, 3 to 6 months. Yeah, maybe. I've seen a lot of high income borrowers with high debt, not much money in the bank, but they are able to manage their finances pretty well given that situation. So I don't know how critical that particular piece is, particularly since in a lot of cases, home buyers are challenged on their down payment. But even so, there are options. He thinks home prices will only keep climbing. As you know from watching this program in the past, I am of the same mind. I think when rates do come down, even though they're not going to come down quickly and dramatically, I think they're going to come down in such a way that home prices are going to still be firm and tend to still be climbing rather than going down. He points out that higher rates mean less competition when you're making offers. I think that's a good point. There is, limited inventory, but higher rates does mean there tends to be less offers being made out there, and that could help you if you do decide to buy now. And then, of course, he says, and I think that's right, higher rates, not a concern if you can qualify for them, and if you've adjusted your overall debt situation to accommodate the home purchase, grab the home now. You're not stuck. Why? When rates fall, you can refinance and get rid of that old mortgage. So this was a pretty timely article. I think he makes some good points that despite this negative environment, there are some reasons why buying now. It's all about whether or not your particular household financially is in good position. There's a lot of homeowners out there, a lot of families, believe it or not, who are in pretty good shape financially, maybe don't have a whole bunch of savings, but they're good on income, maybe don't have a lot of debt. And in that kind of circumstance, it may be a good time to buy. What we have trouble with is, if and I see this sometimes, a dual income situation, husband and wife, both working, both making very good income, but, and they're paying rent. Maybe, they might be making a couple $100,000 a year, but they're paying $4,000 a month in rent, and they want to buy a house. But, they each got a nice car, $800 a month each on a car payment. Maybe they got $30,000 or $40,000 of credit card debt. Well, there's another $2,000 or $3,000 a month just to make the minimum payments. Well, in that situation, there's a realignment that has to occur, because too much of their employment income is getting bled off in car payments and credit card payments, et cetera. And Dave's point is, while I don't think you have to pay off your debt to zero, you do need to get that under control and kind of get it realigned so more of your monthly cash flow is freed up to take on what is going to be a higher housing expense. But at least in that regard, you're getting an asset that most likely is going to appreciate over time and give you that equity. So I just wanted to give a shout out to Dave on this one because I do agree with him in general. And I thought I wanted to share this with you just to encourage you that, as negative as things seem, now may be a good time to buy. And in fact, by the way, just on the last point, places like Zillow are suggesting we may see a little bit of dip in prices in the fall coming up. So given that, and given what Dave's saying, you might want to take a look. So that's it on now's the time to buy a house. And I'm going to bring Jeff back on because we're going to have a couple of questions that we have that we'd like to cover for you.
Yeah, that's some shocking news that you're kind of in alignment with Dave at this point.
Yeah.
It's been a little bit controversial, but
Right.
or adversarial, I guess I should say. So
Mm-hmm.
it's nice to see that, and I agree. It really is one of those things. It's like you mentioned it. It's like, are we thinking short term or long term? And if we're
Right.
doing short term thinking, like, hey, we're just going to buy a house and only stay in a year or two, maybe not a good idea. But if you're thinking about raising a family and really, this is your dream home, like you said, the rates are not going to stay up forever, and you can
No.
even
And that's
Dave's.
it. If you're able to qualify, then if you have the income, then even though you see that's a situation is that I'll often run into someone who they have sufficient income, they're in good shape debt wise, they can qualify for these price levels and these interest rate levels, but they oftentimes choose not to. In
Hmm.
other words, I tell them they can qualify for that $6,000 a month housing expense, but they're like, we don't want to do that. And so they want to wait. Well, the problem is, again, they're trying to time the market at that point. What are they waiting for? They're hoping prices come down. They're hoping rates come down. Well, we're now in an environment where the markets are thinking higher for longer in terms of rates. So you're waiting for prices to come down. I don't see the evidence that they're going to come down enough to take that $6,000 housing expense down to $4,500. I don't see that. So that's what I think some prospective buyers need to think about.
And even things that you've pointed out in the past that, how long it would take for the average American to save the amount of money we're talking about for a down payment. Now we're talking more appreciation in the home that they thought they were going to buy. And so it's kind of like catch 22. It might take them 5 years to get that down payment in line.
Exactly right. Or more.
Yeah. Or
Could be
more.
10
Well,
years. Yeah.
yeah, exactly. Well, I wanted to jump back in today and follow up with what we talked about last week. Last week, if you missed that, you can go back and see it on last week's Mortgage Minute. But we spoke about fees associated with a loan. But this week, I want to talk about the broker's fees. And it's almost one of those things like, I'm asking you how much you make. So it's a little uncomfortable, a little sensitive, but I do want to know when it comes to broker compensation models, how are loan brokers compensated, and, how are they like, as an example, are there totally different compensation models? And if so, can you explain those?
Okay. Yeah, that's a good question. And that whole environment changed after the Great Recession of '08 and the creation of the Consumer Financial Protection Bureau. That created a situation where mortgage originator compensation became regulated by the CFPB. And so that's been the case now for approximately since around 2010. And it's an interesting arrangement. And so let me try to summarize how it works. First of all, I think what we're going to explain here is how mortgage brokers are compensated. And I think that's important. And that's because, as we talked about last week, I think mortgage brokers, I didn't used to think this way, how I first came in the business, but I think mortgage brokers are probably the best option for a home buyer or a homeowner looking to refi because of their focus and specialization in the process in terms of originating the loan and delivering it to a lender. And because there's now hard evidence that going with a broker will save the borrower money over going with a bank or a credit union or a mortgage bank. In addition, I think when you're dealing with a mortgage broker, that gives you the opportunity in the most transparent way to know exactly who that originator you're dealing with is going to get paid or is going to charge for arranging your loan. Dealing with a broker, you have that information readily available, and I think that should be considered a benefit to the borrower. So with that said, what happened was in 2010, the federal government came in and said, we need to regulate how loan officers, mortgage originators are compensated. The way the scheme works is every quarter when we sign up and get approved to deliver loans to a wholesale lender, one of these we have to do is sign an agreement where we are going to declare to that lender what we want for what's called lender paid compensation. What that means is we're going to declare to that lender that we're signing up with how much we want them to pay us when we deliver, Jack and Jill Smith's mortgage loan that they fund.
Hmm.
And so then what happens is they're going to present us essentially a grid. And that grid is going to show numbers from 1% to typically up to 2.75% of the loan amount. And it's usually in eighth or quarter increments. So as a broker, we can say, hey, we want you to pay us 1 point of the loan amount, 1% of the loan amount. That's all we want. On the other end of the spectrum, some brokers will say, we want the max. We want 2.75% of the loan amount. And then in addition to that, you have to pick a number in that grid. And then you also have to declare if you're going to charge a flat fee in addition to that. Like I want 2% of the loan amount plus $300 or plus $500. So you have to declare that. And then lastly, you have to, in most cases, communicate to the lender the minimum amount of compensation you want to be paid on a loan, as well as a max. And that's important because on bigger loan amounts, that can affect what kind of rate the borrower is going to get. So that's what you have to do when you sign up with the lender. And then those numbers, that compensation arrangement, those specific numbers are allowed to be in place quarterly. So in other words, every quarter, us as the broker can go back to our lender and say, we want to tweak this. We want to raise it or lower it. We want to add more of a flat fee, or we want to change our minimum and maximum. So every quarter we have the option to do that. So that's basically how we're compensated. And what's important about that is when you're working with a broker, you can have the ability to find out where they are in that grid. Now, in our case, we have always been told that we are on the low end of that grid. Currently, we are at 1.25% of the borrower's loan amount. And we've been at that level for quite some time. We do not currently have a flat fee added to that. So we're just a flat 1.25. I've talked to many of the account executives with wholesale lenders we deliver loans to. And there's a couple things they tell me. One is they tell me we don't ask for enough compensation. They tell me that we're too low. And part of the reason they tell me that is because I've asked them, well, what do most of your brokers, where do they pick in this grid? And I've been told multiple times, the answers I get are typically somewhere between about 1.8 to 2.25, even 2.5. Wow. So on average, probably close to 2. So why would that be important to a borrower? What's the implication to them? Well, it's pretty significant, actually. In fact, I looked at this today. Based on today's current pricing, if I was going to deliver a loan to this particular lender whose pricing I was checking, to adequately cover our lender paid compensation so that the rate to the borrower would be zero. They wouldn't have to pay an origination fee or points. It'd be what we call 0 points. The rate I could offer covering my 1.25 compensation would be 7.25 today. Now, with that same lender, if I was a broker who had declared at the beginning of the quarter that we wanted 2.25% of the loan amount, the rate that would be available at 0 points to that same borrower wouldn't be 7.25. It would be 7.5.
Wow.
So what's happening is you're paying 0.5% higher rate because the broker you're dealing with chose to submit their lender paid compensation request at a higher rate, a higher percentage of the loan amount than what we do at MortgageWorks. So that's why in a majority of cases, when I'm faced with what appears to be price competition, where a borrower is saying, hey, look, I'm checking with 3 different brokers. I'm like, feel free, go ahead and check with commercial banks too, or a mortgage bank, because given that we require a relatively modest amount of lender paid comp for us to be happy with our numbers and what we're trying to achieve in terms of running the company, go ahead. And what we typically find is we end up having a better deal to the borrower simply because we are not asking our lenders to pay us as much as the next broker down the street that they might be talking to.
So I got just a couple of follow-up questions on that. One is, so if you're a broker and I'm a broker and you decide 1.25 and I decide 2.125 or 2.25, is there a difference in the quality of service we deliver? I mean, the paperwork, does it mean I have to do more things for that same rate?
No, no, that's the point, is that, each broker is different. We're all going to handle the same type of process. We're all going to basically gather up the same kinds of documents and put them in file folders and upload them to lenders and get them underwritten and approved by that lender and funded by that lender. We're all going to go through the same essential process. And we're all following essentially the same rules. Fannie Mae essentially is the sort of the standard as to guidelines for conforming or conventional loans, FHA, VA, of course. So we all are playing by the same rules. So it ultimately comes down to a subjective decision where myself, here at Mortgage Works, what do we think is fair compensation to us while at the same time providing the best rate possible to the borrower? And we decided long ago 1.25. Most other brokers that we compete with, they've made a different decision. Now, there's some out there who are low. I've heard of some that are 1% or 1.25 like us, or 1.5. But it appears from all the years I've been doing this and talking to different wholesale lenders, in most cases, the other brokers that we compete with, they're higher up on that spectrum. They're 1.75, they're 2, they're 2.25. I had a wholesale lender a couple of weeks ago tell me they got brokers that maxed out at 2.75. And I just said, I think that's not fair. I'm not a good enough salesperson to sell the kind of rate that I'd have to offer that borrower in order to be, required that we get paid 2.75% of the loan amount. I just can't do that. I would feel guilty doing that. Putting together a loan file and, all these pieces of paper together to deliver to the lender, it's not really that complicated. And so you start going, well, if we're doing a $500,000 loan and we're going to get paid 1.25% of the loan amount, that's pretty good compensation. Our overhead's low. We can make the business work that way. Why do we need to get paid 2.5% of the loan amount? Heck, that's $12,500 to put a stack of paper together. I think it's a bit much. At least that's the way I've always thought about it. So,
yeah. So another question I have is so if someone out there is shopping for a loan, and it sounds like when there's a higher compensation by the broker, then that shows up in the different rate that they can offer. Is that correct?
That's correct. That's correct.
Yeah. So, and that's for the life of the loan, right?
Well, presumably, which is done in most cases these days, given the volatility in the market. If we are, when we originate a new loan right now, almost always we're locking in that rate right at application. So, if they've gotten a quote from a broker who wants 2.25 compensation from their lender and they're getting one from us, whichever one they pick, which presumably be us, but let's say they pick somebody else, or they didn't check with us and they didn't know that I had something better. When they get that quote, they should, when they lock it in, then it's locked in, and that's what the originator is going to get. I think the point is, though, that in most cases the borrower doesn't really delve into that enough to really know what's going on. Yeah. With us, there's no secrets. I mean, we're happy to explain what we're getting paid. And the other thing that we do is we always make sure we give somebody, a borrower, these numbers, the numbers that we can present to them in terms of rate and fees. We're going to give that to them up front, even before we start the process, through a closing cost worksheet option, which is not considered an official loan estimate, but it's still an acceptable vehicle for us to give a borrower specific numbers right up front before we even start the process. Because really, as long as I know the borrower's credit score, I know the purchase price and the down payment, the loan amount, I can give them a detailed written worksheet. Again, it's not an official loan estimate. It's a worksheet. It's got the proper disclaimers, but they'll know the full story before they even say, yes, Mortgage Works, we want you to do the loan because we like these terms.
Yeah.
And because it's based on our lender paid comp, which is generally lower than our competition, the rate's generally going to be better what they're going to find elsewhere.
Well, so would you categorize Mortgage Works as a discount brokerage?
No, I mean, I don't like to present it that way. In fact, when I was with a mortgage bank, the first, fourth of my career, or not fourth, about, a third of my career, that was it. It's like, we sort of like downplay them as, oh, those are discount broker or originators, mortgage companies that, they don't know what they're doing, blah, 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 limited menu, all that kind of stuff. So no, I don't consider us a discount broker, at least in terms of the stereotype of a discount broker or mortgage originator, what I like to think is that, yeah, we may offer discounted, price for the loan is, I think, a good way to think about it. But with the added element of highly experienced and knowledgeable about the products, the process, the underwriting criteria the borrower has to meet and get through, we add that additional element of being, essentially experts at what we do. And in other words, I would like to think of us as essentially on the same level, or, as a borrower's attorney or their CPA, at a professional standard that, pretty high standard. So we have, those features. We're very hands-on, very consultative in terms of dealing with our customer, very knowledgeable, experienced. We've been through it all. We know we've been through every scenario I can ever think of. But yet I'm going to deliver that process, that experience at a much better price than I would say a majority of my competition does. But I think in a way, mortgages cost too much to the borrower. So
yeah, it sounds like you've decided long ago that you're going to produce high quality product at a very fair price.
Right.
And that seems to have worked for you for 40 plus years.
Right. Yeah.
Right.
Yep.
I do want to ask a little follow-up question. You said that this particular compensation package changed at about 2010. What was happening before then?
Well, yeah, that's a good question. It's kind of the Wild West, frankly. At that time, certainly before '97, for example, when I was at the mortgage banking company, it was a lot different in that, within the company as a loan officer, you would get a daily rate sheet from the company, and essentially that was our wholesale price, and then we would simply negotiate a final price with the borrower. As a loan officer, we could decide, do we want to earn 1.5% on the loan, or do we want to earn 2%? And of course, in those days, you'd usually split the commission 50-50. So, I might say, I'm going to originate this loan at 1.5% to the company. So I'm going to get half of that. I'm going to get 0.75% of the loan amount. So that's, we just did that. Here's our raw rate sheet, and we would decide deal by deal what we were going to offer the borrower. And of course, that turned out to be hazardous because of concerns about, are we giving certain people, certain groups better deals than others? And then, of course, there was the problem of some loan officers would literally quote a deal off a daily rate sheet, essentially promise it to the borrower, sometimes in writing, but not lock it with the company's lock desk and let it do what we call float. Why? Because they were betting the market would improve, and they would lock it the next day, hoping they would gather more income, capture more income for the company, and get a bigger commission. The problem was that they were wrong. Then they were faced with having to either own up to their guarantee, essentially, and accept less commission, or maybe no commission if they were really wrong. And of course, in the worst case scenario, they would play that kind of game and then not deliver what they promised and change the terms on the borrower. So it was a crazy, kind of, like I said, a Wild West time. And so those kind of situations are all pretty much gone now.
So what advice would you give someone who's a home buyer and they're starting this whole process? What's one word of advice, or one piece of advice you would give them that would help them? I'm not going to say that I would love for them to always go to MortgageWorks, but to make sure that they're treated fairly when it comes to compensation from the brokerage.
Well, there's a couple of things. First of all, if they're going to be shopping around for a mortgage, one of the things I always do, particularly if you're comparing more than one originator to another, be sure to always get the numbers, the quotes on the same day, typically even at the same time of the day. I know that sounds silly, but what a lot of folks don't realize, the bond market, which is what drives mortgage rates, is just like the stock market. It goes up and down every day and intraday, during the day. So I can give somebody a worksheet with a quote an hour ago, and an hour later it could be no longer valid. And so I'll run into problems sometimes where I'll give somebody a quote based on today's market, and they'll say, "Oh, I have a better deal." And you have it in writing? Yeah, send me a copy. They send it to me. It's from a week ago when the market was better. So you have to compare mortgage originators, mortgage offers. You have to compare them on the same day. That's vitally important. And the next thing is, I would urge that you get it in writing, get a worksheet. Some lenders will say, "Oh, I can't do it until you get an offer accepted because I can't give you an LE." That's true. They can't give you an LE, but they can give you a worksheet. There's a standard form format in the industry. It can be used to give somebody all the numbers right up front. And in that process, that's where you should ask your originator, particularly if you know you're dealing with a broker, based on these terms, what's your lender paid compensation? I mean, that should be the question. What's your lender paid compensation for these terms? You can make a judgment about if you think it's fair or not. But I think as a borrower, you're entitled to know that.
Wow, that sounds fair. Well, Art, first of all, thank you so much for being just very transparent about all of this and really kind of bringing us into the understanding of what's really going on out there. And I don't think anyone that watches this now or in the future will say, well, brokers shouldn't be compensated. That's not even a question. And that's why I asked you the one question about, well, if somebody has a higher rate, are they doing more or different work than you? If you say it's exactly the same work and the results are the same, but my rate is higher by half a point or a quarter of a point, which turns out to be a much higher, mortgage payment. You got to think twice about that. So I would encourage you to go see Art at MortgageWorks. With that, Art, I'm going to turn it back over to you again. Thank you so much for sharing this.
Thanks, Jeff. Okay, everyone. Now we're going to go into our closing question from last week and finish up here for today. The question, as you may recall, is can seasonal employment be used for qualifying income? And the answer is yes. Both Fannie Mae and FHA VA have similar criteria on this. You have to have a 2-year history. You have to document that income is associated with seasonal layoffs expected to recur and is being reported for tax purposes. So it can't be a cash job where you're working on a seasonal basis. It's got to be reported income. The good thing about this kind of employee or employment situation is we can use unemployment income for qualifying as well, as long as there is the same 2-year history. So this is something we do from time to time here in our market in the Coachella Valley, the greater Palm Springs area. We've done loans for some of the folks working at the resort areas, country clubs, et cetera, who are routinely laid off every summer in the quote unquote off season, typically laid off in May and then they come back in October. So that kind of borrower we've served many times and use this approach to make sure that they can get qualified. Same with agricultural workers, same issue in terms of the growing season and so forth. The one thing I added here, though, is beware of the timing of closing where we have to go through the verbal VOE process. Remember, when we're getting ready to close a loan, we have to get a verbal verification of employment. That's basically a phone call to make sure the borrower is still at their job. Well, that can be tricky with a seasonal employee. I ran into this a couple of years ago where we were trying to close a purchase loan for a borrower who was working for one of the country clubs, not due back officially at work until October 1. We were trying to close in September. And the HR person at the country club was playing hardball and wanted to just stick to the technicality that he was laid off, even though he had over 15 years with the company, with that resort, with that country club. So we managed to get around that eventually. So just understand that can be a tricky little point associated with somebody who is a seasonal employee and trying to get their loan closed. So with that, let me go over what our closing question is for next week. And that question is, this is a very good question, one we run into all the time. What's the difference between being pre-qualified and being pre-approved? Again, what's the difference between pre-qualification and pre-approval? I'll dive into that next week on the Mortgage Minute. Remember, that's where we'll have the answers, and they're on the house. Jeff, back to you.
Art, once again, like I said, this is one of the most exciting days of the week. It's Thursday. It's Mortgage Minute Thursday. I can't tell you how much I appreciate you sharing the information about Dave is actually in alignment with you and says, hey, buy now, and it's always one of those things that, now money is better than future money because of time. And so if you can do it and get your things in order, which Art will make sure that, you properly have those things, do it now. Sure. I love that one line he said in there about saying, hey, with the interest rates the way they are, you may have fewer people to compete against. Well, of course, that makes it more negotiable, does it not?
Sure does. And in fact, in that regard, that's where you can, go out and take a look around and maybe have some leverage in terms of negotiating an offer. And again, I'll bring it back again. In doing so, maybe, use some strategies like asking for seller, don't just whack at that purchase price. Maybe leave that list price where it is, but ask for a significant concession to pay, for a temporary buy down, closing costs, both. That way, you're getting both the home that you want, getting it at some, at least initially, financing terms that are going to be pretty comfortable. And it buys you more time to wait for that opportunity to refi and throw away that old mortgage and get something a little bit lower once rates get there. So
I like it. Well,
yeah.
If you're thinking about it, you're on the fence. Here's Art's information. You can call him at his office at 760-883-5700. The flashing phone, you don't see it's in his pocket. It's 714-612-9035. That does have a waterproof device even when he's swimming laps, because he's svelte. He will answer it. So he'll have that with him. And of course, you can always go to the website at mwloans.com and Art at mwloans.com. Art, anything new happening tonight? You got anything going on? I know you are always networking.
Yeah. Actually, I'll be at the out here in the desert area, the California Desert Association of Realtors Expo. That's actually a program for realtors who are members of the association to come see and talk to all of us affiliates. So looking forward to that. That's at 5:00. So that's what we got on the agenda for later today.
Fantastic. Well, again, Art, thank you so much. And again, if you have questions, put them in the comments. Art will respond to them. And in the meantime, we'll see you next week for another fantastic Thursday. Art, we'll leave it to you.
All right. Thanks, Jeff. Thanks, everyone. Thanks for watching and listening. Remember, my name is Art Alvarez. I'm with Mortgage Works, where we do have the answers, and they're on the house. We'll see you again next week. Thank you. Take care.